Welcome. Today we're covering interest rates and stock prices, how the Fed moves markets. Let's get started. The Federal Reserve is the most powerful force in financial markets. By raising or lowering the federal funds rate, the Fed influences borrowing costs throughout the entire economy, from mortgages to corporate loans to savings accounts. Every investor needs to understand how this affects stock prices. When interest rates rise, stock prices typically fall, especially for growth stocks. This happens for two reasons. Companies pay more to borrow money, hurting profits, and future earnings are worth less in today's dollars because they're discounted at a higher rate. Meanwhile, bonds offer more competitive yields. The opposite is true when the Fed cuts rates. Borrowing becomes cheaper, companies invest more aggressively, and the present value of future earnings rises. Investors often rotate from bonds back into stocks, particularly high-growth companies whose value depends heavily on future cash flows. The yield curve shows the relationship between short and long-term interest rates. When it inverts, meaning short-term rates exceed long-term rates, it has historically been a reliable recession warning. Investors watch the spread between the 2-year and 10-year Treasury yields as a key macro signal. For long-term investors, the practical takeaway is to stay diversified rather than trying to time Fed moves. In rising rate environments, value stocks and banks tend to outperform. In falling rate environments, growth stocks and REITs benefit most. Understand the dynamics but don't overreact to each announcement.